Yeah, I think a lot of it depends on how much of the weakness from overseas starts to wash up on our shores. I think the Fed is getting a sense of that, as is investors, and we're starting to see the dollar slip as a result of that, notwithstanding some of the move today. So the question is, are we still insulated? But I will say that the announcement the Fed said standing pat for the rest of the year is unprecedented. I've never really, that's something that maybe Mario Draghi would say, but not necessarily a Fed chairman.
Jeff, do you agree? And where do you think there's most opportunity for investors here?
I think investors have breathed some sigh of relief that the Fed has indicated it's going to pause and that maybe that's less threat of a near-term recession. But look, it may allow cost pressures to continue to rise and risk an earnings recession, if not an economic one. Profit margins have peaked and have already begun to decline as wages have hit a 10-year high, not just here in the U.S., but in Germany and Japan. Those sectors that tend to do better in an environment of slowing sales growth but rising costs tend to be healthcare and consumer staples. Those may be two areas that investors may want to look to.
You know, Jack, I don't know if you were able to catch the whole press conference, but there was one question asked of Chairman Powell, and the question was something to the effect of, are you concerned that the effect of your dovishness is going to inflate asset prices? And he said, no, we're in a different time now. It's completely different. Yet here we are, and we're seeing the same old playbook, right? Once again, the Fed's on the sidelines, and we're seeing a reflation of the momentum trade, the growth stocks. Technology is so strong in today's session with the NASDAQ leading and information technology and the S&P up 2.4%. Do we go back to that old playbook at this point, Jack, now that the Fed has said, you know what, we're out?
Yeah, I mean, I think that, it's got to be careful what you wish for. I mean, a lot of the move, I should say, in asset prices was as a result of central bank policy. We still have remarkably interest rates right now in the 10-year are the same rate that they were in March of 2009, right at the height of the financial maelstrom. So, interest rates have really is really the only asset class that has not responded, even though the stock market's up, more than 400% from that point. So I do think, given that we have aggressively low interest rates, that's propping up asset prices, and we still have more than $8 trillion of bonds with negative yields. That doesn't seem to be going away. So I think a lot of what happens depends on rates. As Fed President Kaplan talked about how leveraged our economy is to rates, I think the global economy is too. So I think rates stay where they are and go lower. And as long as we have some couple dollar weakness, we still prefer emerging markets, stocks and bonds, just because they're much cheaper than a lot of equity markets around the world.
Jeff, here in the United States, how should we think about valuations? How much more can we get in valuation from rates coming down?
I don't think a lot. I think context is critically important to why the Fed is pausing here. It's because global economic growth is slowing. The purchasing managers indices continue to come down. Leading economic indicators from the OECD continue to fall, not just in the U.S., in Europe, in Japan, in China, everywhere around the world. Now, that may slow down, that slowdown may begin to abate, but it is still slowing. And so if we don't get any kind of momentum on the earnings front, if earnings revisions continue to head to the downside, it's really hard to get valuations to expand here. I'd point back to 2016. That was a year where, after the Fed had hiked in December of 15, markets put a high probability on a cut by the Fed. That didn't happen. The Fed ended up hiking rates at the end of the year, but you didn't even see outperformance by, sorry, Jack, emerging markets in 2016. Even they lagged the U.S. stock market because of those concerns about global growth, that context being so important.